Thanks everyone for joining. We'll make a start here in just a couple of seconds. I'll give everyone just a few seconds here to get dialed over from their other meetings, but yeah, we'll make a start in just a second. I think just to start making a slow start a while, just want to start out by saying thank you, cover off some of the thank yous, etc., off at the front. So I want to say thank you to everyone for dialing in today. Hello, welcome to the Altus analysis of the NCREIF ODCE Index results. These will be the latest results for the second quarter of 2025. My name is Mike Amthor. I lead the U.S. Performance and Valuation Analytics part of our business. I'm happy to be here to talk about the latest movement in the ODCE Index with Alex Jaffe. I'm joined by Alex. He is a regional lead senior director in our valuation advisory practice. Over the next hour, we're going to be taking you through the latest ODCE results to second quarter 2025. This is an overview of the entirety of the NCREIF ODCE Index, 25 funds. And then within Altus Group, we have an extensive valuation data set. We match up against the ODCE Index, provide some additional insights beyond those return figures. This webinar serves to provide market insights to our wider client network and industry, but also serves as a basis for our upcoming one-to-one client conversations with those clients who are NCREIF contributors and have this analysis replicated on a portfolio and comparative basis. We look forward to having this conversation with those clients over the next several weeks. Before passing it over to Alex, I do want to say thank you to everyone involved in getting this pulled together. It's an extensive effort with many people involved, many components across the business and the industry. So I want to say thank you to everybody in our advisory group, the other members of our performance analysis team, certainly the marketing team for getting this all set up, our clients for privileged access to their data, and certainly also NCREIF for providing the index figures. We do have a couple polling questions throughout the webinar, so we'll switch over to those as we get to them. But first, want to revisit the responses to the poll that we ran at the end of last quarter's webinar, which is a poll that we ask every quarter. So Alex, do you want to remind us how the audience responded to the final poll of last quarter's webinar?
Yep. So Mike, first, great to be with you and look forward to connecting over the next 58 minutes. Last quarter, we asked a polling question where the expectation would be for second quarter unlevered property return. Majority of respondents anticipated the total unlevered property return would be 1 to 3%. There were a couple that thought it was going to be stronger, a couple that thought it was going to be lower. But Mike, how was the forecast last quarter? How did it compare to where we saw 2Q end up with the results?
Thanks, Alex. So majority anticipated that 1 to 3% total return. The majority was correct. We were at the lower end of that range. So second quarter 2025 total return down just a shade this quarter from last quarter, but sits at 1.2%. And that is largely aligned with last quarter's return. Couple notes on the latest return, as well as this return series that takes us back sort of to the start of that pandemic period. We are now at 4 consecutive quarters of positive total returns, becoming further removed from that period of 7 consecutive quarters of negative total returns. There is some positive appreciation in the most recent quarter's number. We'll see that on the next slide. Now that's 2 consecutive quarters of positive appreciation, so continuing on that positive value momentum within the index for 2025. And then just to mention that, as I said, the most recent quarter's return is not a whole lot different from last quarter. There is some variance among the sectors, but not a ton of change. That period of market calm generally persisting against a backdrop of uncertainty. So that's the latest quarter and really the latest component of the cycle that we find ourselves in now. If we just take a quick look back over the history since the start of the pandemic, we've really broken that into 4 distinct periods. The first is really the onset of that pandemic, where we saw returns momentarily turn negative. So second quarter 2020, we experienced a negative return. That was then followed by that post-pandemic upswing, where we then saw 9 consecutive quarters of positive total returns. And then, as mentioned, there was that rising interest rate period, where most of those gains were reversed in the negative 7 quarters of negative total returns that we experienced off the back that post-pandemic growth period. So those 3 periods sort of defining the roller coaster of movement that we had seen through the early parts of the pandemic, really the first 5 years of the pandemic, and now we're into sort of what seems to be a more stable positive total return period. Just a reminder, these returns, these results are based on purely unleveraged real estate at ownership share. So there's no impact of cash, no leverage, mark to market of that leverage, no fees, none of that fund level impact that influences value. So this is purely on real estate value movements. So that's total return. As mentioned, that'll be comprised of both income and appreciation. So if we then break that total return into its component income and appreciation parts on the next slide. So I've got income in green, appreciation in red. I mentioned that positive appreciation return in the most recent quarter. That'll be plus 0.2%. And again, that's our second consecutive quarter of positive appreciation, following on 2 quarters of fairly minimal but negative appreciation. But those 2 quarters had wrapped up really 10 quarters of negative appreciation that we had seen over that rising interest rate period. Before I get into the appreciation history, I'll just mention the income return, fairly stable. I saw that reduce a bit through that post-pandemic growth period, and then has been picking up more recently and flattened out in the past couple of quarters. That is income divided by the capital base, really divided by value, to simplify it. So all to say that varying income return is more of a product of the denominator effect, with values changing, increasing through that growth period and then coming down more recently. So not a whole lot of volatility in that income return. Where we see most of the influence to the total return, plus or minus, is on that appreciation side of things. And as mentioned, we've been breaking that appreciation series into those 3 distinct periods. So you have that initial pandemic pullback on the left-hand side, where we saw values come down about 2%. That was followed by that post-pandemic growth period, where we saw 7 consecutive quarters of positive appreciation, resulting in about 24% increase to values through that period. That was then offset by those 10 consecutive quarters of negative appreciation that we saw during that rising interest rate period, which saw values come down about 20%. And then, as mentioned, we're now sort of finding ourselves in this 4th phase where we're seeing positive appreciation and values are up about 0.3% cumulative over those 2 periods. We take that full pandemic movement, pandemic and post-pandemic movement into account. If we look at things on a cumulative basis, values are still down just about 3% in the current quarter, at the end of the most recent quarter, relative to where they sat at the end of 2019. This income appreciation, what we're then able to do at Altus Group is take a look within that appreciation return and the value movements behind the real estate, and layer in the extensive valuation data set that we have here at Altus Group. Just to orient you around this slide and the concepts within this appreciation breakdown, we take that red bar on the appreciation return on the prior slide, transcribe it to the red line here, and then we break that appreciation into value change components, yield and cash flow, the yellow and blue bars, and then the impact of the actual capital spend. To explain those a bit further, the yield impact, the yellow bar, that'll be the impact from movement in discount and exit rate only. So really your impact of your investor sentiment, changes in pricing, changes in yield. On the cash flow side of things, the blue bar, that represents movements in that 10-year underlying discounted cash flow projection that was being priced by those yields, whether that's factual, contract rents, additional leasing expenses, market assumptions, market rent growth, projected capital, etc. So that will all fall under the cash flow effect. That's your value change, and then there is still an ongoing capital spend to generate that value change, and that'll be represented by the gray bar, the capital impact. That brings us from value change down to appreciation. So with that in mind, most recent period, you can see that there's minimal yield impact. It's effectively flat at 0%, where there is positive appreciation that's generated from cash flow uplift. So now the fourth consecutive quarter of positive cash flow movement, coming off of a period of fairly muted cash flow movements during that rising interest rate environment. If we look at the most recent downturn, you can see that was almost entirely due to rising yield rates. So yield impacts negative through those 10 quarters and even beyond that, while cash flows were effectively flat. While cash flow has been positive over the past 4 quarters, it is still fairly muted. So while that is a positive, we're not quite seeing the same cash flow gains that we had seen through that prior growth period. So cash flow movements moving into more favorable territory. We'll see if this trend continues to be the new normal, or if those pick up or scale back at all. So minimal yield movement, continued cash flow upside. Alex, what do you make of the latest movements, both from a pricing and a cash flow perspective, against the backdrop of this muddled macro environment, where yields have seemingly stabilized to some degree, but cash flows continue to sort of march upwards?
Yep. So Mike, I would summarize it as we saw a remarkably uneventful second quarter. Certainly, as you just laid out, no major change to yield or capital market assumptions, and performance, under or over performance, was primarily driven by individual assets or fundamentals of those assets. Last quarter in the webinar, I know Robbie and Phil had discussions, or what seemed like disclaimers, on Liberation Day. We spent a lot of time this quarter talking about tariffs, GDP, interest rate cuts or lack thereof, movement in 10-year treasuries, reverse denominator effect. The list sort of goes on and on about what we've talked about during the quarter, but ultimately we didn't see much change in the values, and in some ways that's a steady hand in uncertain times, which is a good thing. And this really mirrored our client discussions. We've seen some repositioning in portfolios, we've seen some acquisition, some disposition, but we didn't see major movements in strategy or composition. And so we would say, again, second quarter is similar or pretty steady relative to what it was in Q1. But Mike, maybe I'll pass back to you. I know each sector is a little bit different, and we can dive deeper into individual themes.
Yep. Thanks, Alex. As Alex alluded to, we break that total return out by the individual sectors. So again, just to sort of orient you around this slide, we've got 1 quarter returns for the past 12 or so quarters. Most recent on the right, so your second quarter 2025 return, there's our 1.2% all life cycle total return on a stabilized or operating only basis. That's 1.3%. You can see that's right in line with last quarter on an operating basis, and certainly, as I mentioned, positive after a fairly notable negative, that downturn that we saw through that rising interest rate period. So that 1.3% return, fairly similar. That'll vary by sector. We did see retail step up, continue at that 2% mark in the most recent quarter. So retail at the top of the stack. Apartment and other did see some uptick from to about that 1.5%, 1.5% for apartment, 1.6% for other. So both of those have ticked up to some degree. And then on the flip side, industrial, we saw that drop down about 50 basis points in the most recent quarter to just about 0.9% total return. And interesting to note, on an operating stabilized basis in second quarter 2025, the industrial total return actually did slip behind the office total return. So this is the first that office hasn't been at the bottom of the stack in quite some time. That said, this will be total returns. This includes both income and appreciation. Office currently sitting at a 1.4 to 1.5% income return. So appreciation is still negative within office, and then industrial, which sits closer to a 1% income return, still does see some negative appreciation in the most recent quarter, but to a much lesser degree than office. But we'll pick that apart as we go through the individual sectors. The last point to make on this slide, at the bottom, we have the sector return spread. So that's the highest returning sector return minus the lowest returning sector's return. And you can see the most recent quarter that has shrunk down to 1.1% on an operating or stabilized basis. And the thing there is that we continue to see those returns converge across the sectors after seeing fairly widespread on this chart, which you can see over that rising interest rate period where we saw those negative returns. But if we go to the next slide, which charts out all of those individual sector returns back to really the start of that pandemic initial adjustment, you can see the returns clustering on the right-hand side, so that 1.1 to 1.3% differential between the lowest returning and highest returning sectors. But just want to point out the contrast of more recent movements to the past three components of this cycle that we pointed out, where office really set the floor of returns through that rising interest rate period, along with that office fundamental readjustment to larger spread there. Prior to that, we had that post-pandemic growth period, which were really dominated by industrial, along with other and multifamily, sort of gapping out on the upside. And then prior to that, in that initial pandemic adjustment, we saw retail down at the bottom, which certainly took the brunt of the negative appreciation early in the pandemic. Last point to note on this slide, those returns are all clustered and they are all currently in positive total return territory. That said, that total return will be a combination of income and appreciation. On the next slide here, breaking out those components as we did with the overall returns. Most recent quarter, you can see it's primarily an income return across the sector. So as with the overall, fairly minimal appreciation in the most recent quarter, you can see positives led by retail and then to a lesser degree apartment. And then on the appreciation side, the negative, just a slight sliver of negative appreciation for industrial in the most recent quarter. And then within office, slightly more pronounced negative appreciation in second quarter 2025. So that's the most recent movements. If we look back at the history here, again, sort of through that pandemic period, and as sort of evidenced by the past handful of slides, we saw that initial pandemic pullback within retail, so negative appreciation coming early, retail fairly stagnant otherwise, with the exception of that rising interest rate period. Then we saw that post-pandemic growth period dominated by industrial and multifamily, positive appreciation. And then during that rising interest rate period, all four sectors experiencing some level of value decline: apartment, industrial, office, and retail. Again, retail most muted in terms of the negative value influences, and office most pronounced. Office also had that fundamental shift as the backdrop, resulting in continued value decline. So again, return mostly income in the most recent quarter with minimal appreciation. But if we do take a look at the influences behind those appreciation returns on the next slide, as we did on an all sector basis, again, yield impact fairly flat in the most recent quarter. Second quarter 2025 will be off on the right hand side. And you can see in all four sectors, there's effectively no yellow bar, no yield impact in the most recent quarter. That said, we do see continued positive cash flow impact. So that'll be led by retail and then to a lesser degree apartment, and then industrial and office, those cash flows fairly flat. So that positive cash flow impact sort of on an aggregate basis, and that we've seen really driven by retail and then to a lesser extent apartment and industrial, trending in the right direction, as again we saw cash flows fairly stagnant through that rising interest rate period, particularly in apartment and retail, whereas in industrial we saw some continued uplift followed by some stagnation, but office really had acted as a headwind on those cash flow impacts. One last note I'll make here is that that income return, that office appreciation return negative in the most recent quarter. You can see there's been fairly minimal both yield and cash flow impact. So office value change fairly muted, not a whole lot of value movement on office in aggregate. That said, where there is negative appreciation, you can see it's due to that gray bar, that ongoing capital spend within office. And that office capital spend in the recent period and over the recent cycle seems to be much higher than it is in the other sectors. So Alex, wanted to get your thoughts on that, on office value movement as well as the ongoing capital spend within that sector.
Yep. And just for everyone who has not joined before, we make the slides available afterwards. So if you want to zoom into the office, you can certainly do that subsequent. But there is much larger capital, or the gray bars, in the past few quarters on office. And just as a reminder, that capital spend is not just building renovation, common area amenities, but that also includes TI allowances. And so for office, the good news is we have seen leases being executed, we have seen activity, but we're seeing a large amount of TI allowance that's coming through, hence the large gray bar, or the net effective rent for office is potentially value neutral, not increasing the cash flow, or the blue bar, but essentially it's flat. So again, it's good news we've seen leasing in office, but it's been at a pretty high cost, or upfront cost, on the TI allowance. And so, as Mike mentioned, it's something that we've seen over the past few quarters, and that's really dragged the performance of office, in addition to the other shift in demand. So Mike, maybe back to you.
Alex. So that's the yield and cash flow influences history for the 4 main property types. Just to mention then other, we are using still the classic subtype, so self-storage falls within other, but just to show how yield and cash flow influences have played out within that sector, and then the largest component of that sector over that same history. But the main notes here is that in recent quarters, again, not a whole lot of yield movement, pricing fairly stable within other and self-storage, where there has been positive momentum on the appreciation front. It has generally been from continued upward movement to cash flow fundamentals, and now consistent with the all sector yield and cash flow movements. We do see positive cash flow impact over the past 4 quarters within other and self-storage. So that really sort of mirrors the overall all sector TAC. So that's yield, appreciation, yield, cash flow history. If we focus then on just the most recent quarter, and this is where within Altus Group we're able to take that yield and cash flow breakout and then start to dig into the individual valuation measures, the contractual components, as well as the valuation assumptions incorporated within those valuation models, and dig into what are the primary components influencing those value movements. So first, looking at the appreciation as well as that appreciation breakdown, yield, cash flow, and capital across the main sectors, as well as a total line there in the middle. We do see most positive appreciation coming through within retail. So retail sitting at the top, led by that positive cash flow effect, followed by apartment and other. And then down below, we have industrial, and then to a larger degree, office, seeing some negative appreciation in the most recent quarter. Second quarter 2025, we saw minimal yield impact. So as we saw in that return series, the history, yield impacts fairly muted in the most recent quarter. Slight uptick in value due to yield movements in apartment, and then on the flip side, some slight expansion on retail. But you can see that those impacts quite minimal. Where there is value movement in the most recent quarter, that tends to be differentiated by the cash flow effect, and then as mentioned on the last slide, that ongoing capital spend within office tends to be a drag on that return. But important note to make is that we are seeing positive cash flow fundamental movements in second quarter 2025 across sectors, again with office sitting fairly muted in the most recent quarter. So not a whole lot of movement in second quarter 2025. If we zoom out a bit and look at the influences over the past year, we start to see a bit more differentiation among the sectors. And really the main differentiation that we can see seems to be split between office and the rest. So we've seen fairly minimal yield impact over the past 4 quarters on an all sector basis. As we get further away from that rising interest rate environment, you can see yield impacts over the past year fairly muted for retail, apartment, industrial, as well as other. Where there has been pressure, it's been continued upward movement on yields within the office sector. And then beyond that, over the past year, we've seen positive cash flow fundamental influences across, again, apartment, industrial, retail, and other. but then office is the lone sector that has seen some continued pullback on cash flows over the past year. So all to say, seems like there's still adjustment being made to office, particularly on an individual asset basis, whereas the other sectors led by retail have been enjoying fairly notable upward movement to cash flow fundamentals over the past year as we move further away from that rising interest rate negative appreciation component of the cycle. That's yield and cash flow influences over the past year. If we first then focus on the components of that yield impact on the next slide here, looking at count and terminal cap rate movements across the main sectors, really back to pre-pandemic period. What we saw early in the pandemic, we saw retail continuing its upward trend in rates that had really started in 2017 and 2018. So it was really the first to see upward movement to rates when the pandemic hit. Then we saw that post-pandemic growth period where we saw fairly notable compression to rates within industrial and apartment. You can see how low those got, while retail and office effectively stagnated during that growth period. Then we moved into that rising interest rate period where rates among all sectors started to increase. Retail to the lowest degree, given that it had already been repriced to a large degree, and then industrial and apartment to the largest degree, given that they had seen that fairly notable compression during that post-pandemic growth period. But then we saw the shift in office fundamentals really start to take hold in earnest, and we saw rates start to increase at a much more rapid rate, much more rapid pace of change for office, both on discount and exit cap rates than we did for the other sectors. So all to just point out that double influence within office of both the rising interest rate environment as well as that fundamental repricing. That's the history. If you look at the most recent quarter, again, not a whole lot to report in second quarter 2025 relative to first quarter 2025. Rates effectively flattening out across the four sectors. Although I will say it is notable the spread in both discount and exit rates that we see right now relative to what we saw leading into the pandemic. That's the yield side of things. Again, not a whole lot of movement in the most recent quarter. If we then look at the components of the cash flow impact, so again, just to orient you around the charts on this slide, cash flow impact, that's the value change due to cash flow movements on the left-hand side, ordered from highest appreciation to lowest. And then we've got the change in 6 cash flow impacting measures within those valuation DCF models. This will be same store change. So 1 quarter same store change in each of these measures. One note, these changes do not sum the cash flow impact. This is simply showing the change in each of these measures from first quarter 2025 to second quarter 2025. So to point out a couple of themes on this slide, that positive cash flow influence in retail continues to be sort of the main driver of positive cash flow on an all sector basis. That's led by continued uplift to both contract and market rents, as well as some increase to that market rent growth assumption. Then you've got apartment and other, both of those with, again, positive cash flow movements, other driven by a combination of occupancy, contract rents, also some reduction in expenses and capital. Apartment then, you've got continued increase to contract rents, some increase to market rents as well, and then some occupancy uptick. Then you have industrial and office sitting down at the lower end of the cash flow stacks, both positive, but fairly muted positive. Industrial, similar to apartment, has some market rent uptick, and we do see continued upward momentum on contract rents within industrial, but that occupancy within industrial has slipped to some degree. And I think that's the 4th consecutive quarter of negative same-store movement in occupancy that we've seen within industrial. So retail, apartment, other, industrial, and then lastly within office. Office, fairly muted movements across the valuation measures, and while there are still some greens across the board here, you can still see that there's continued upward movement to the expense ratio. That will be your expenses divided by your revenue, so essentially increasing expenses reducing revenue, and then also continued increase to that capital expense ratio, with that capital expense ratio being the projected capital, whether that's building capital, lobby renovation, elevators, etc., or whether that's tenant capital, including tenant improvements, commitments, etc. The last point I'll make there is that the rent growth, we've got the rent growth inset down at the bottom to show the trends in that 10-year projected rent growth assumption. We saw during that post-pandemic growth period, industrial and apartment really saw that rent growth assumption step up to a large degree. On the flip side, in that initial pandemic pullback, retail and to a lesser degree office saw fairly significant pullback on those rent growth assumptions. With that office sort of fundamental shift, we've seen further reduction in the rent growth assumption. All to point out that while we do see some upward movement in that rent growth assumption in the most recent quarter within office, we're coming off of a very low base, roughly 2.6% within office. So while there is some recovery there, and even within retail, retail's still fighting its way back up to that sort of 3% inflationary standard, whereas apartment and industrial are still coming off of the highs that they experienced during that post-pandemic growth period. So, Alex, with sort of the yield and cash flow movements in mind, what's your take on sort of those valuation measure movements and the influences behind those value changes across the various sectors?
Yep. So as we talked about, not a big story for yield this quarter. It's all about cash flow. And echo what you would say, Mike, we continue to see retail surprise to the upside. Early on, this was burn off of COVID leases, short-term activity that was done just to get through the early pandemic. But we're continuing to see steady leasing activity, strong sales volumes, really across almost all retail subsectors. And then we're also seeing more acquisition activity in retail, whether that's in ODCE funds or non-ODCE funds we work with. And each has a different, it seems like, niche or focus, whether that's grocery anchored. We've seen strip non-anchored. We've seen a couple different retail strategies. And so again, surprised, but not surprised given how strong retail has been. The other thing we would just compare and contrast is the divergence in cash flow characteristics for apartment and industrial. Apartment fundamentally, the occupancy was stable this past quarter. Contract rents have ticked up. Market rents have ticked up. Minor pullback in market rent growth. So again, that seems stable. If you really compare that to industrial, we saw decline in occupancy. Yes, we saw some increase in contract rent, but part of that is the long-term duration of the lease. But we also continue to see pullback in market rent growth and higher OPEX. So again, the value movement has deviated this quarter from apartment versus industrial. And I think part of that is we're seeing the fundamentals more stable in apartment. Industrial, there is some soft spots. But Mike, I know we'll look further into individual MSAs within industrial. I don't think that's true for every MSA. But again, I think it's an interesting comparison between those two sectors, which have significant weighting in ODCE.
Yep. Thanks, Alex. So with that backdrop, in terms of those appreciation influences in the most recent quarter, those value influences across the various sectors, we've included a series of charts here showing really the value movements across those sectors. So in these charts, for each sector, we've plotted the percent of assets by count that have experienced a value increase in green, value decrease in red, and then no change to value in yellow. What I'd note here is that the most recent quarter, things look more balanced. We've got more green than red, certainly in apartment, industrial, and retail, and even office to some degree. Recent cash flow influences, as we saw on the last slide, things generally positive. So we would expect a bit more green on the page than red in recent quarters. And that also really just serves the contrast versus the roller coaster that we've experienced since the start of the pandemic. We had that initial pandemic pullback where we saw values down really sort of across the board. And then that post-pandemic growth period where there was significantly more green than red, And then in the more recent down cycle, where we've seen values come down fairly notably, much more red than green. So it feels like we're entering sort of a more stable period for valuations with a bit more green than red. That said, there are certainly going to be property-specific movements within these. That's why there is still some red, despite the upward trend in the market in recent quarters. And that also doesn't speak to the magnitude of the changes or really the range of value movements, improvements, and declines that we've seen across the various sectors and even within sectors. So that's a nice sort of segue into portfolio composition and the allocation across the various sectors and how the ODCE index has weighted to the various sectors over time. So we've showed this chart before. I think a lot of themes that have been picked out of this. I'll just mention a couple initial points. You see, and sorry, to orient you around this will be the percentage weighting by sector for the ODCE index over time. So starting on the left-hand side, we had fourth quarter 2015, and then on the right-hand side, that's through second quarter 2025, the most recent quarter. You can see at the bottom, apartment has been fairly stable. So the ODCE index allocation to apartment has generally been fairly unchanged over that period. And I'll mention at the top, retail in that blue teal and other in that orangish. Retail has reduced to some degree. That really had happened quite a bit through 18, 19, in the initial stages of the pandemic, whereas other those alternative asset classes have seen more of an increase in more recent quarters. You've seen that other allocation increase as well. The main takeaways from this slide to me, though, are the fact that office in purple and industrial in green have effectively inverted over the past 10 years. So whereas in fourth quarter of 2019, office took up about 35% of the index and industrial about 18% of the index, now in second quarter 2025, industrial takes up about 35% of the index and office takes up about 17% of the index. So those have effectively flipped over the past 5+ years. And with that in mind, given that inversion, we wanted to take a look and compare those two sectors and a couple other valuation and performance components of those two sectors. So looking at industrial and office, we've plotted on the top left the weight by market value for office in purple, industrial in green. On the top right hand, or on the right hand side up top, we've got the income return for each of those sectors. And then down below, we've got the 10-year average cap rate. That'll be the forward projected valuation-based 10-year average cap rate. So I mentioned the inversion in weighting. You can see how those have effectively mirrored one another, office tapering off, while industrial has really picked up steam. We've got the relative, the difference industrial minus office represented by the gray bars. So office always had a notable lead in terms of allocation. That inverted to now where industrial has a significant over allocation relative to office. On the income return, industrial had run higher than office really for the full period leading into the pandemic. Those also have flipped, so you can see they cross, and now certainly some volatility in the office income return. I'll speak to that just a bit, but now industrial sitting below office in terms of income return in the most recent one, currently over the past 5 or so years. And then lastly, that 10-year average cap rate. We looked at a handful of valuation measures, pricing, discount rate, exit rate going in, but settled on the 10-year average cap rate, sort of as a proxy for investor sentiment. And similarly, you saw industrial always had a bit of a premium on that 10-year cap rate through that ODCE history, but those crossed over as well to now where that industrial 10-year cap rate sits well below the office 10-year cap rate. So with that context in mind, and just sort of orienting around the charts, Alex, what do you make of the shift between industrial and office over the past 5+ years, 10 years really?
Yeah, so I would say the first thing on the 10-year average cap rate, and we do get this question a lot when we're meeting with market participants. The green cap rate is somewhat artificially low because there is still embedded below market rent. We estimate it's 20 to 25% of below market rent or burn off. So arguably that green 10-year average cap rate would be slightly higher today if we moved everything to market. But I don't think the story is any different, Mike. I think it's interesting that, you know, these three metrics have flip-flopped over time. And to me, this is less a story about you should pick this sector or you should overweight or underweight, but it's more sort of the benefit of diversification. We've seen major shifts in themes, you know, over the past 10 years. You know, I think it's pretty shocking that, you know, these two sectors have inverted in almost every measure. And so I think it speaks to having a balanced CRE portfolio, because it's really difficult to forecast, you know, under or overweighting. The other one we did not put on here, Mike, is we didn't include retail, but I know, as you've talked about, that's gone through some changes as well. And now we're seeing sort of outperformance with retail. And so I think that's another area where it's pretty tough to, you know, potentially time some of these cyclical or non-cyclical shifts that occur. But all of that being said, and Mike, if I'm speaking to diversification, if you did have to pick one sector going forward, what would you choose? We wanted to poll the audience for what they would think will be the best performing sector, not over the next 10 years, but just over the next 12 months. Mike, the choices here, apartment, industrial, office, retail, or other, where we've categorized other as approximately 50% of storage. My vote would be retail. It seems like every quarter we think retail will slow, and it hasn't yet. So, you know, I would anticipate retail to do well. But Mike, what's your take before we see what the audience voted?
Yeah, thanks, Alex. I think I'll join you with retail. I think there might be an argument to be made for apartment over the next year as industrial continues to fight influences that it has over the past couple of quarters. But I think I'm going to have to stick with retail for you, or with you.
Okay. And then are we able to see the results? So it looked like, Mike, similar to what you said, both apartment and retail were leading, 45% apartment and then 33% retail. And then it was less than 10% on the other sectors. So anyways, so Mike, want to pass back to you. I know we'll start to walk through the individual MSAs underneath each property sector.
Thanks, Alex. So yeah, that generally wraps up the sort of national sector look that we've taken, and now we want to break we're really layering the geography so we can start to pick across the movements within those sectors. So these charts here, these are total returns on an operating basis. Most recent quarter up top by sector and CBSA. So sectors on the left, CBSA's markets across the top, ordered west to east generally. Most recent quarter up top, prior quarter in the middle, and then the difference between second quarter and first quarter down below. Won't spend too much time on this chart. As Alex mentioned, we'll go into the individual sectors. Wanted to leave this in sort of for context, but generally speaking, returns fairly similar to last quarter. I mentioned that we saw some uptick in apartment and other in the most recent quarter, and then on an operating basis, we saw industrial step back about 50 basis points. So given that industrial had the largest delta between first quarter and second quarter, stepped back to the largest degree, we thought that we would start by focusing on the industrial sector. So in this chart, in this table, we've included last 4 quarters returns up top, most recent quarters down at the bottom of those 4 in the gold box. And we've got 1-year, 3-year, and 5-year returns down below. Just to mention the color coding, the colors are relative to the sector average. So anything above 0.9% in second quarter will be some shade of green. Anything below 0.9% will be some shade of red. So the main points to note here are that in the most recent quarter, we see generally green fairly across the board. The exception then, of course, is in Southern California and the West Coast in general, but in particular Los Angeles and Inland Empire. Again, these are total returns, so that'll be positive income offset by negative appreciation in each of those. And then to mention smaller market, San Diego, Seattle also struggling to some degree. But focusing on Los Angeles and Inland Empire, excuse me, given those 2 CBSAs make up roughly 1/4 of the ODCE Industrial Index. These 2 CBSAs have been dominating industrial trends for the past 5 years. More recently, we've seen that pullback over the past 4 quarters. Those have been subdued over the past year and 3-year period. But if we look at things over the 5-year period, these are 2 of the strongest components of the industrial market, really falling just behind Miami in terms of that uplift over the 5-year period. So certainly some pressure more recently in Inland Empire and Los Angeles, but just want to mention the context that those have seen pretty remarkable upside over the past 5 years when we take everything on a net basis. So those are total returns. If we get into the appreciation component behind industrial, so on the left-hand side, we've got the second quarter or most recent quarters appreciation breakdown. CBSAs ordered from highest appreciation to lowest. Then we've got the yield and cash flow impacts associated with those. And then on the right-hand side, we've got the same charts, yield and cash flow, across the various industrial CBSAs. Note that the 2 quarters are ordered independently of one another from highest appreciation to lowest. So you can't look across the CBSAs, more just looking at the general influences within yield and cash flow this quarter versus last quarter. So not a whole lot of yield movement in the most recent quarter, a bit less of a general positive influence than we saw in first quarter 2025. But sort of the main takeaway here is really within the cash flows, where we see positive cash flow influence. Generally, again, I want to say mostly across the board, not fully across the board, but where we do see pullback both last quarter and in the most recent quarter is within those Southern California industrial cash flow. So negative cash flow impact for Los Angeles, Inland Empire, as well as San Diego in the most recent quarter, and that mirrors last quarter's negative cash flow influences in Los Angeles and Riverside. So again, continuing to see some pressure within that Inland Empire, or sorry, that Southern California industrial contingent. If we look into the valuation measure movement behind those yield and cash flow influences, we see fairly widespread uptick on contract rents. That's really true everywhere, including those more recently challenged Southern California markets. That said, where we've seen pullback, it is traced to the market rent side of things. Rent growth is fairly stable, some positives, some negatives, and even market rents continuing to pick up on the higher appreciation components more recently within that industrial index. But it is the market rent pullback that has been sort of the determinant in recent quarters within Southern California. So with that in mind, we wanted to dig just a bit deeper into those Southern California rent dynamics. So what we've done is we have plotted rent trends for both Inland Empire and Los Angeles. A couple notes on this chart. So this represents industrial warehouse stabilized only in Inland Empire and Los Angeles. LA will be in green. And then we've subdivided the Inland Empire into Inland Empire East and Inland Empire West. So East will be in orange, and then West will be in blue. And really, this is the results of plotting all of the valuations, the ODCE valuations that we work with within those markets, and how those rents have trended from the start of 2019 to the most recent period. So, Alex, I'll pass it over to you. What's your read on the movements and the dynamics within these Southern California rent movements?
Yep. So I'd say the first thing, just looking at the chart, all 3 markets are materially up since 2019. So if you look at the left-hand side, we were talking $5 to $10 rents. Now we're talking $10 to $15 to $20 rents. So, they've certainly seen significant increase. That being said, we have noted material value declines from 22 or 2023 to today. So they're coming down, but again, just as a reminder, they're still up from where we were pre-pandemic. Our other read of the data that's interesting here is that that the blue bar, and as Mike mentioned, West Inland Empire, it seemed that it started to converge or almost be an extension of LA in 21, 22, 23. So those bars were much tighter, and it's now come back down, or it's more similar to Inland Empire East today. And if you look pre-pandemic, Inland Empire East, Inland Empire West, there was still a spread between the two, but they were closer, whereas LA had a notable premium in market rent. And it looks like now we're sort of reverting back to, those differentials in market rent in 25 and where we were in 2019. And then the other thing I'd say is, just as a reminder, we've only plotted geography and market rent here. There's certainly differences in property types based on clear height, age, office finish, trailer parking, number of dock doors. And so that's part of the reason too why we see you see some of the outliers or whiskers on some of the tails. So, you know, yes, these are the general themes, but certainly there could be differences or certain physical descriptive characteristics by property. And so again, just as a reminder, we think the data you know, is thematically correct, but there could be slight variations by property. And what we're doing this quarter is we're meeting with our clients, and what we think will be a great discussion is if we juxtapose their portfolios with this type of chart to understand how their rents have moved in Inland Empire or LA relative to what we're seeing as a peer group. So maybe Mike, I'll pass back to you. I know we talked a lot of industrial, but I want to make sure we save some time for office and the other sectors. So I'll pass back to you.
Thanks, Alex. Appreciate that. And yeah, definitely some interesting dynamics that we found through that Southern California rent analysis. So now moving on to office. Most recent quarter, office returns fairly flat, or office values fairly flat. That 1% total return, again, that'll be essentially a 1.4, 1.5% income return with some negative appreciation. But we do start to see office holding its ground across a handful of CBSAs where there is pressure in the most recent quarter within office. It tends to be concentrated in individual pockets, a lot of times concentrated within individual assets. So where we do see more subdued returns this quarter in Seattle, Dallas, Atlanta, Boston to some degree, a lot of that is very asset specific. As with apartment and industrial, or excuse me, with an industrial, we've plotted longer term returns down below. So while those influences more recently are certainly very asset specific, over the longer term, we have certainly seen many of the gateway markets be most affected. So if you look at Seattle, San Francisco, Chicago, Washington, D.C., and New York, those tend to be the most impacted markets over that full 5-year period, which encompasses the vast majority of office movement in the recent cycle. If we look at the appreciation influences behind office in the most recent quarter, again, movements generally fairly muted, some positive yield impacts, some negative, a lot of that, again, very asset or event specific. Cash flows also fairly mixed, fairly muted, not a whole lot of movement. Where there is pressure in the most recent quarter, it tends to be a combination of some yield and some cash flow. And more specifically, we continue to see within that cash flow impact, that capital expense ratio continue to tick up. So more projected capital within those models, again, whether that's building capital, tenant capital, or a combination of both. But given the fairly muted movement in the most recent quarter, we've also included the 5-year appreciation influences for office. And you can see really that the magnitude of correction that office has experienced over the 5-year period. I do want to mention these appreciation figures are annualized. So where we're looking at a roughly 14 and change % negative appreciation in Chicago over the 5-year period, that's roughly 14 and change % per year. So that's roughly 56% total. So Chicago office values are down over 50% over the past 5 years. So just want to contextualize that. But it's a combination of yield and cash flow. So on the yield effect side of things, we see that negative value influence due to that rising interest rate period, coupled with that sort of fundamental repricing within office. So hit on both sides there. And then on the cash flow side of things, where most sectors have seen fairly stable cash flows or increases from the start of the pandemic, you can see that cash flow positions have really come back within office over the past 5 years. Again, a lot of that, the higher movement, larger movements have been in those gateway CBSAs. So if you look at Chicago, New York, DC, Seattle, San Francisco, down at the bottom, those are most impacted from a cash flow perspective. We've seen occupancy come down across the board. That rent growth assumption, as we looked at a handful of slides ago, has really been pared back within office. And then the expenses and also that projected capital, both of those have increased materially since the period 5 years ago. So all to say, we've seen sort of this notable fundamental shift in office valuations over the past 5 years across CBSA and concentrated with those gateways. So that's office. We then take a look at apartment. So apartment, most recent quarter, that total return fairly consistent with last quarter. We saw about 20 basis points increase quarter over quarter. More recent periods, we've actually started to see some of those more challenged gateway markets, or previously more challenged gateway markets, making a bit of a resurgence. The likes of Seattle, San Francisco, Chicago, New York, Boston, even DC holding its own to some degree. Those have been a bit more positive in the most recent quarter. And on the flip side, some of those Sunbelt markets, the darlings of sort of the first half of that pandemic movement, those have been more subdued more recently. So if you look at Denver, Dallas, Houston, San Diego, and then other, which contains a lot of those Southeast non-top 15 markets. So depending on what you consider Sunbelt, a lot of those Sunbelt smile markets have seen more muted returns more recently. That's been a theme for the past year or so if we look at the 1-year returns, but that picture changes as we look back over the longer time periods down at the bottom, over a 3 and a 5-year basis. So you look at Phoenix, San Diego, Denver, Dallas, Houston, et cetera, the Sunbelt markets tend to be the ones that have seen more positive movement over the 5-year period, whereas the gateways, Seattle, San Francisco, Chicago, et cetera, New York, have been more muted when we look at things over that full 5-year period. And just to dig into that a bit, again, with an apartment comparing quarter versus quarter. So the general trend that we've seen last quarter as well as this quarter, that gateway market resurgence, some of the positive cash flow influences coming in some of those gateways, more pronounced this quarter than last. Then also, whereas last quarter we saw some pullback on cash flows, particularly down at the bottom of those Sunbelt markets, a lot of that due to that expense increase, so new budgets being incorporated into models. That dynamic is not in play this quarter. So down at the bottom, we're really seeing cash flows flattening out to some degree. So if we expand that cash flow impact out a bit, as I mentioned, you can look at that expense ratio. That's fairly flat in the most recent quarter, so not a whole lot of change in the dynamic between expenses and revenues. Where there is positive influence at the top of the stack on the cash flows, it is market rents continuing to tick up within those CBSAs, whereas they've effectively flattened out down at the bottom in those, again, Sunbelt smile markets. So Alex, just wanted to get your thoughts on that Sunbelt gateway dynamic, what we've seen in more recent periods versus longer term as well.
Yeah, so I would say, Mike, echo the sentiment. Looks like the gateway markets are outperforming. I think what was interesting this quarter is the Sunbelt markets on this chart, Phoenix, Dallas, Denver had a minor adjustment. If you look in the other category, while we've heard a lot about oversupply, we're really not seeing it in negative cash flow effect. It's not as strong as the gateway markets was this quarter, but it looks like we've either hit stabilization or we're just not seeing that oversupply continue to impact these Sunbelt markets like we have in the prior quarter. So Mike, that's what we saw this quarter, but if you take a step back, how does that look like over a 5-year time horizon or sort of a longer investment period?
Yeah, that's a good point. I certainly alluded to it to some degree previously, but if we line up the appreciation returns again top to bottom on a 5-year basis, if you look at the top, we've got the legs of Miami, Phoenix, Inland Empire, Dallas, Atlanta, and then down at the bottom, again, San Francisco, Chicago, New York, Seattle, Los Angeles. There has been some negative influence due to yield impact, sort of across the board, again, rising interest rate environment, but the cash flow is really the determinant, the cash flow movement in that appreciation rank order. And you can see that market rent tends to be the main driver there. So those markets that have fared better over the past 5 years have seen more of an increase to that market rent relative to those gateway markets. And lastly, to touch on retail, generally a positive story in the most recent quarter, so positive appreciation for all subtypes. You can see that across the board on the left-hand side. Yield impact fairly muted. We do see just a slight negative influence on value due to yield movements in the most recent quarter, but it is positive cash flow impact driven by continued uptick in contract rents as well as market rent, especially at the top end within that super regional mall category. And generally speaking, the top of the appreciation stack tends to be focused more around that discretionary spend, again, destination super regional malls, as well as fashion specialty. So that's an interesting dynamic. That said, if we look at things over the full 5-year period, it's the neighborhood and power centers that have held out better than the other retail subtypes. When we look at things over the 5-year period, we see that negative yield impact from the rising interest rate environment. But that said, it is generally a positive cash flow impact story. 5 years takes us back to right after that initial COVID adjustment. So we've seen, to Alex's point, continued uptick in contract rents. This will be a combination of converting those COVID era leases as well as more recent leasing activity, but then also notable uptick to market rent as well as the recovery of those rent growth assumptions. And I think that takes us to our last poll. So Alex.
Yeah, so those who have stayed, we appreciate it. We're 1 minute over, so apologies, but real quick. What is the expectation for total unlevered property return in 3Q25? Just as a reminder, it was 1.2%, as Mike showed early in the presentation. First option is greater than 3%. Second option is 1 to 3%. And then that third option is less than 1%. So given we're over, if we could look at the poll results. Looks like most people might think that we will be in that same band of 1 to 3% unlevered property return for 3Q. So thanks for the feedback. And maybe Mike, I'll pass to you with some closing remarks.
Yep. Thanks, Alex. Appreciate that. And as Alex mentioned, thanks to everybody who stayed on. Just to sort of wrap up the main points that we covered throughout the webinar today. Most recent quarter, that total return is positive again, 4th consecutive quarter positive total return. Appreciation return also positive in the most recent quarter. That's our 2nd consecutive quarter of positive appreciation. So continuing on that momentum from 1st quarter 2025. Yield rates have largely stabilized, not a whole lot of yield impact in 2nd quarter. It really is that cash flow impact that's differentiated the sectors. Cash flow is generally still positive across the board. Appreciation has improved to some degree from last quarter in apartment, retail, and other, but has stepped back and is negative appreciation in both office and industrial in 2nd quarter 2025. Within industrial, the main theme is the pullback in market rent in Southern California, continuing to act as a headwind for the sector as a total. Within office, not a whole lot of wider movement. It really is asset specifics that tend to drive individual market segment performance in recent periods. With an apartment, gateways have been sort of experiencing that resurgence, but as we saw, they're really playing catch up to some degree and have lagged the Sun Belt when we look at things over the full pandemic period. And then in retail, it's that upward momentum on cash flows led by super regional fashion specialty more recently, but over the full pandemic period, neighborhood and power centers have proven more resilient. So, wanted to say thank you again to everybody who joined the webinar and who helped get things set up. Certainly, if you have questions, we have a question box and you can submit those and we'll be sure to follow up after the webinar. But yeah, just wanted to say thanks again to everyone for joining, everybody who helped set this up. And Alex, thanks for spending the time to go through the analysis with me.
Likewise, Mike, great to be with you. Hope everyone has a good afternoon.